Have you ever heard of a business that was making a ton of money on paper, with huge profits reported every quarter, only to suddenly go bankrupt? It sounds completely backward, right? How can you be profitable and simultaneously run out of cash? It's a puzzle that trips up so many people, new business owners, everyday investors trying to pick the next big stock. The core of this mystery lies in a simple but critical distinction: the difference between profit and actual physical cash in the bank. This is where the cash flow statement comes in, acting as the ultimate truth teller in the world of finance, showing you exactly where the money came from and where it went. So, if the income statement can be a little misleading, what's the solution? The answer is the cash flow statement. Think of it as a financial documentary of a company's money over a specific period, a quarter or a year. It doesn't care about accounting theories or promises of future payments. It's brutally honest. It tracks only one thing: the movement of cold, hard cash. It shows every single dollar that came into the business, and every single dollar that went out. No hiding, just cash in versus cash out. It's the closest you can get to looking into the company's bank account. The importance of this statement cannot be overstated. For a business, it's a critical survival tool. Profit is an accounting concept. It's calculated by taking your revenue and subtracting all your expenses. But here's the kicker: many of those revenues haven't been collected yet, and many of those expenses haven't been paid. For example, a company could make a massive $1 million sale and record that as revenue immediately. But what if the client has 90 days to pay? For the next 3 months, that $1 million is just an IOU. It's not cash you can use to pay your employees or keep the lights on. This is where so many businesses get into serious trouble. They get excited about their growing profits and start spending money they don't actually have yet. They might hire more staff, buy new equipment, or expand into a new office, all based on the promise of future payments. Meanwhile, their real-world cash reserves are dwindling fast. They have rent to pay this month, salaries due this Friday, inventory suppliers who want their money now. The business is technically profitable, but their bank account is screaming for help. This disconnect is precisely why we need a better tool to see the real-time movement of money. The first, and arguably most important section of the cash flow statement is cash flow from operating activities. This is the heart and soul of the business. It measures the cash generated by a company's primary day-to-day business activities. Sell a product. Sell a service. This section shows how much cash they bring in from those core operations. It includes every dollar of cash received from customers, and subtracts the cash paid out for expenses like employee salaries, rent, utility bills, and payments to suppliers for inventory. A positive cash flow from operations is a fantastic sign. It means the company's main business model is working and is self-sufficient, enough to reinvest, pay down debt, and return to shareholders. On the flip side, a negative cash flow from operations is a major red flag. It suggests that customers aren't paying on time, costs are too high, or sales are simply too low. It's like owning a restaurant where the cost of ingredients and staff is more than the money you get from diners. Let's use a simple personal example to make this crystal clear. For an individual, your operating cash flow is your monthly income minus your everyday living expenses. Your salary or wages are your cash inflow, your job. The cash outflows are all the things you need to pay for just to live: rent or mortgage, grocery bill, car payment, gas, utility bills. If your paycheck is $4,000 and your total living expenses are $3,000, your personal cash flow from operations is a positive $1,000. That's money you can now use for other things. For a business, this section starts with the net income figure from the income statement and then makes adjustments to strip out all the non-cash items, like adding back depreciation and adjusting receivables and payables. If accounts receivable goes up, it means the company made sales but hasn't collected the cash yet, so that amount is subtracted from net income to get the true cash figure. It's all about the cash. The second section of the cash flow statement: cash flow from investing activities. This part tells you how a company is spending its cash on long-term assets to grow and maintain the business. It's about strategic decisions for the future: property, plants, equipment, often called PP&E. Example purchases: a new delivery truck, building a new factory, acquiring a smaller competitor. The cash used shows up here as a cash outflow. It's money going out the door. Conversely, selling an old building, a piece of machinery, or investments like stocks or bonds creates a cash inflow in this section. This section reveals the company's investment strategy. Is it in a growth phase, pouring cash into new assets to expand? or consolidating, selling non-essential assets to raise cash or streamline. A consistently high cash outflow often indicates heavy investment in future growth. If a mature company shows large positive inflows from selling assets, it can be a warning sign. Your cash flow from investing includes buying or selling assets. For example, buying a new laptop for your side hustle, purchasing shares of stock. Both are cash outflows. Selling a car or stocks brings inflows. Alright, so the third and final section is the cash flow from financing activities. This section shows how a company raises money to run its business and how it pays that money back to its investors and lenders. Cash between the company and shareholders, banks, and bondholders. When a company takes out a new bank loan or issues new shares of stock to the public to raise capital, the money it receives is a cash inflow, fueling operations and growth. On the other side, financing outflows include making payments on loan principal, buying back its own stock, and paying dividends to shareholders. In your personal life, student loans, car loans, or a mortgage create a financing inflow when you receive the funds. Monthly principal repayments are financing outflows. Borrow $50 from a friend, financing inflow, pay it back, outflow. For companies, a young startup might show large positive cash flow from financing as it raises money. A mature company might show negative financing cash flow as it pays down debt, pays dividends, and executes buybacks. A company constantly raising new debt just to cover operating losses is a huge red flag, indicating an unsustainable business model. Example 1. Receiving $1,000 salary, operating cash inflow. Example 2. Buying a $500 laptop for your side hustle, investing cash outflow. Example 3. Repaying $200 of a loan principal, financing cash outflow. Visual. Flowchart. Operating, investing, financing boxes pointing to cash balance. Together, they tell you where cash really moved. Ultimately, the cash flow statement provides context. It bridges the gap between the income statement, profitability, and the balance sheet, a snapshot of assets and liabilities. It tells the story of how a company got from one point to another. Did cash increase because sales are booming, or because it took out a massive loan? Did cash decrease due to weak sales or a strategic factory investment? The cash flow statement answers these crucial questions by showing cash from operations, investing, and financing, clearly, honestly. The cash flow statement isn't just an obscure document for accountants, it's a powerful tool for anyone who wants to understand true financial health. For investors, it's an indispensable part of due diligence. Income statements can be manipulated. The cash flow statement is much harder to fake. Cash is either in the bank or it isn't. Investors check cash flow from operations to see if the core business actually generates money. Strong and growing operating cash flow signals a high-quality business. Business owners, especially small and medium-sized, live and die by cash flow. They use the cash flow statement as a management tool to plan ahead. By forecasting inflows and outflows, they can anticipate shortfalls and arrange financing before it becomes an emergency. Can we afford to hire a new employee next month? Do we have enough cash to buy that new machine? If a big new client pays in 90 days, can we cover payroll in the meantime? For individuals, understanding cash flow is the bedrock of personal financial success. Create a simple cash flow statement each month. It's empowering. It forces you to see exactly where your money goes. Subscriptions, dining out, impulse purchases. Once you see the numbers in black and white, you can make informed decisions. Cut back and free cash to redirect into investing, buying index funds, or financing. Paying down high-interest credit cards faster. Look at money flowing through operations, investing, financing. Do you generate enough cash from core activity to support growth and obligations? Is it investing wisely? Managing debt and equity responsibly? Picking a stock? Running a business? Building your savings? Asking these questions in the cash flow statement puts you far ahead of the curve. Without looking at the flow of actual cash, you're essentially flying blind. It's like trying to gauge your personal wealth by only looking at the value of your house. Sure, it might be worth a lot, but you can't use a tiny fraction of your roof to buy groceries. You need liquid cash. When people first start looking at financial statements, they often make a few common mistakes. The biggest is confusing profit with cash. People see a huge net income and assume it's rolling in money. But that profit might be tied up in unpaid invoices, accounts receivable. Always look at the cash flow statement alongside the income statement. Specifically, compare net income to cash flow from operations. Do. Compare profit to cash. Don't. Assume profit. Balzar cash. Do. Analyze all three sections. Don't. Only look at operations. Another classic mistake is ignoring the investing section and the financing section. A company might have fantastic operating cash flow, but zero spending on new equipment or research, neglecting future growth. Tip: look at all three sections together. Healthy pattern: positive operations, negative investing, growth. Neutral or negative financing: paying down debt or rewarding shareholders. Positive cash flow from investing can mean selling assets. Large positive cash from financing can mean taking on debt or diluting shareholders. The key is to ask why. Finally, don't overlook one-time events. Always review several years to identify trends. Focus on consistency and the direction of operating cash flow over 3 to 5 years. So, we've journeyed through the sometimes confusing world of financial statements and uncovered the ultimate source of truth: the cash flow statement. We started with the puzzle of how a profitable company can go broke, the gap between accounting profit and actual cash, operating, investing, financing. With these, we can see with clarity how money moves through a business or even through our personal lives. The cash from operations is the engine. The cash from investing is the blueprint. The cash from financing is the foundation. Each section provides a unique piece of the puzzle, and together they reveal true financial health. Remember the pitfalls: mistaking profit for cash, ignoring investing and financing, failing to look at long-term trends. Ultimately, cash is king. Profit is an opinion, but cash is a fact. A business needs cash to survive, to pay its people, to invest in its future, and to weather any economic storm. Understanding and mastering cash flow is a fundamental life skill. Start tracking your own personal cash flow. Review a company's cash flow statement you admire. If you found this helpful, subscribe for more simple finance and accounting guides.